Okay, we're going to get started by looking at the S&P like we usually do. Um, you can see whenever we're looking at our trend lines, we've been in a downtrend for about a month and a half now. And you can see we're making lower lows and lower highs. But you can see that we broke through this uptrend, the top part of our downtrend, and we're about right here right now. So it looks like we could be forming a um, higher high and higher low. There's something called a breadth thrust that triggered right in these 10 days from the maximum pessimism to um, a move up. So I'll go over that later on, but um, we're not out of the clear yet for this downtrend. We are deciding whether we want to resume an uptrend here or continue the downtrend. And I guess that's pretty much at the mercy of the headline news. I'm sorry to say that, but right now, a lot of the moves in the stock market are based on whims of the president, and can't do anything about that. But in general, what you got to do when you're investing is kind of look beyond day-to-day headlines and just look at the numbers. So I picked out a couple good stocks that are down this year and look like they're undervalued. They could be stocks that you can buy and hold for a long time. Okay, so let's look at our talking points for today's meeting. Okay, look at our calendar. We're right in the middle of earnings season. We had Google report their earnings, or Alphabet report their earnings this week. We had Tesla report their earnings. Tesla actually reported their earnings on the 22nd, and they were abysmal. They were truly poor. But Elon Musk came on the call, which he usually doesn't, and he said, "I'm going to be more active in the company," and that made the stock go up quite a bit. Also, they had a news story that the federal government has a self-driving rules that were um, sent out, and that really helped the stock also. So their future is riding on full self-driving vehicles. So next week we're going to have some more big tech companies like Microsoft, Apple, um, and Amazon, a couple other big companies. So that's why last week I highlighted the end of this week and this week as green, because usually earnings kick stocks into gear. All right, so we did have really good earnings by Google this week, and that helped that stock. It's actually in the downtrend. We'll go over it later on today. We got to wait a whole month before we get to NVIDIA earnings, so it's not going to be. So we have to wait for that. They're always 1 month later than all the other tech stocks. And what else do we have to look forward to? We have a holiday in May, and we also have Juneteenth and federal holidays, and of course, July 4th. July 4th is one of the ones that one of the most celebrated um, holidays, and a lot of times you have almost a guaranteed green around that date. So you have really good times, really good feelings. It's good weather around the country. So a lot of times that's one of the best times to expect the stock market to go up. Okay, so let's go over some of our talking points. Um, okay, we have been in a downtrend for quite a while, and let's go back and look at this downtrend. Yeah, we've been in this for a long time. We're starting to gain a little bit of momentum in the stock market. In other words, we were 25% above the 50-day, 30% above the 200-day. Now we're going up to 32% and 32% for both the 50-day and the 200-day moving average. So we're gaining a little bit of momentum in the stock market. Our fear, we're less fearful at the end of this week than we were at the beginning of the week. We have like a manic depressive kind of market, and that doesn't remember a couple of days ago. We have it's just um, capricious. It's very um, we have a very fickle market that reacts on the slightest news stories. So we have the S&P up 4% this week, and we have the Fed is on hold for raising or lowering interest rates. Um, and let me see. Let's look at the 10-year Treasury. You can see that it has the stock market has gone up while the 10-year has gone down this week. So you can see we have that inverse correlation again, which is normal in the stock market. So um, that is what we've had for quite a long time. So that's really good. We want to see the 10-year Treasury going down. That'll help a lot of the stocks that need to borrow money. All right, so now let's look at a couple things. First of all, we could be starting a new uptrend in the S&P. We don't know right now. We're just like on that edge of going to this higher high and this higher low, or we break down and go to a lower low and we test the bottom. A lot of times when you have, a huge downtrend like this, like a 15% drop in a short amount of time, there's people that predict that you retest the bottom. So if we go down on a news story in the coming month or so, just remember there's a lot of support at this level where we went to before. And but it seems as though we're starting a new uptrend. We have a lot of momentum. We'll go over that a little bit later on. There's something called a thrust indicator that if you have a lot of um, more buying than selling after there's a huge more selling than buying, that's called a thrust. And there are different types of thrusts, and we'll go over a couple of those later on today. But what that indicates is if you have this kind of momentum in the stock market for a short period of time, a year later it's usually up around 20%, the stock market. So we'll keep our eyes on that. It's not a short thing. It's kind of hocus pocus, but it's something to keep in mind. And if enough people believe in something, then sometimes it becomes true. That's like some of these charts that we're following. If we look at our charts and if enough people follow these trend lines, they actually end up turning out to be true, or they actually work. Okay, so let's look at some more talking points. This is a trend line going back to the COVID lows of 2000. You can see that we trace the bottoms and the tops of the stock market. We went down almost exactly to the penny to this multi-year trend line, 5-year trend line. So that is support. That is a true amount of support. And when we go and we look at this, we also have that 5-year support for this mark right here. So if we go down the stock market again, down to this low, we have not only a 5-year support for that level, we have this double bottom. If we bounce off of that, then it's almost sure thing that we're going to go up in the next bull market. All right, so let's go down to our next talking point. The price of oil is remaining low. That's indicating that the economies around the world are slowing, and probably including the United States. And what else do we have to know about this? Oh, um, high oil is inflationary. So if we have a lower price of oil, that helps inflation. So that's a good sign. And the inflation is kind of cooling. Right now it's 2.39%. That isn't changing. We do have tariff pressures. So as the tariff situation resolves itself, um, if we have a lot of tariffs, it's going to increase the price of things. And that's going to cause inflation. So we'll watch out for that. And it seems like so far there's a lot of bluffing by the president. And if the president comes out someday and says we have 100% tariffs on all nations, um, you can't take it seriously. It seems like it's becoming negotiating tool. So anyway, let's look at the dollar index. The dollar index is the same as last week. It's unchanged, but it is in a downtrend. As the dollar goes down, that helps the multinationals and the stocks doing business overseas, companies doing business overseas. We have gold down 1%. Um, you can see that gold has been one of the um, beneficiaries of funds this year. Let's look at the gold ETF. You can see this is the best chart of this year. It's up 24%. Um, but it's in a situation where I think I mentioned this last week. Whenever you have a very good performing asset in your portfolio, a lot of times you sell your winner to fund your losers. And this has been overbought. This is like the Mag 7 from last year. Eventually, it's a crowded trade. It's one of the only things that's working this year. So um, whenever too many people are buying something, eventually people start taking profits and sell it. So that's probably what happened to gold. All right, so let's look at what else. A stronger US dollar tends to drive gold prices. Hold on, lower. So we have a weaker dollar, so that should make gold prices go higher. So that's been helping gold all this year, the weak dollar. And okay, so we can see the dollar index, it's in a downtrend. And the fear and greed index is currently at fear. We've experienced the last 2 weeks at extreme fear. So fear, there's no panic right now. There's people are just kind of still a little bit fearful. Um, it's time to start looking for something to buy. It's not whenever last week we had extreme fear, it's hold your nose and buy something or don't sell. Um, okay, this is the amateur AAII sentiment survey, and they're still bearish. This is the most amount of bearish weeks in a row of all time, at least since the financial crisis. In the VIX, we have down to 25. So we have a de-escalation of fear in the stock market. So now we have um, basically back to normal times 25. So not a lot of people are afraid of the stock market going down now. We probably right here in the emotional index, we have last week we had capitulation, maybe a moment or two of despair. Um, Now we're basically back in this fearful mode. Um, I guess people could be starting to take off, and they're testing the waters to start putting money back into the stock market. And then you're going to get some people talking on the TV. Everyone's starting to get back in, and then people start getting greedy again. So this is the first time we experienced capitulation together, so that's awesome. We had a lot of these things happening at once. We had the AI stock bubble losing confidence. We had economy slowing down into a recession. We have 50% recession odds now by a lot of um, banks. We have massive government layoffs, weak dollar. We had random Trump actions every day of this week. So all of these things lead to lack of confidence, and that led to this capitulation from last week. All right. So even now we're still have a PE ratio of 21, which is overvalued. We still have 20% to go in the stock market before we're fairly valued. If we end up going into a recession, right now the odds are like 40 or 50%, according to famous people. And if we go into recession, the stock market very well could go down another 20%. You got to be ready for that. Okay, we're going through our worst to first, like we do every week. The best from last year that were up 30% are down around 12, 14% this year. The worst from last year were only up 1%. They're break even to down 1 or 2%. So it definitely is a total flip from last year. And yeah, some of the healthiest sectors are healthcare, consumer staples, utilities. All right. So let me see, what else do we have to say here? Okay, we're going to go over. Okay, we're going to go over the sectors that are going up and down today. Okay, let's look at the stocks going up and down. We have Tesla as it's up actually over 20% this week. Tesla had super poor earnings, but Elon Musk said he's going to quit working for the government and focus on Tesla full time. And that was enough to get people excited to bid the stock up. They had horrible earnings, but it continues to go up for some reason. All right. And what other stocks? Okay. So the ones that went down the most, we have T-Mobile. This is a stock we follow. Let's look at T-Mobile's numbers. I did the estimates for this. They're growing around 20% a year, and their PE ratio is 25. So they're just a little bit overvalued, like 25% overvalued. They're growing at 25%. Most phone companies are only growing like 5%, like AT&T and T and Verizon. They're growing 0 to 5%, but they pay a dividend. This is a little bit different. They don't pay, T-Mobile doesn't pay much of a dividend, but they grow their earnings a lot faster. But they disappointed on their earnings report today, and they went down 11%. That's pretty major. Let's look at the numbers for T-Mobile. Okay, the forward PE is 24, and the PEG ratio is 1.43. So Yahoo Finance thinks that they're growing something around 14% or 17%, and it's pretty rich right now. But they've overtaken AT&T and Verizon as the largest telecom company in the country. You can see that their profit margin is pretty good at 14. Their return on equity is better than we expect at 19. And their total debt is, oh, well, look at that. $120 billion in debt, and their market cap that's half of their market cap. So that's one of their biggest problems right now. They have half of their market cap is in debt. So they they're making billion a year in free cash flow. So it'll take 10 years to pay that debt off. Um, if they paid off their debt with their free cash flow. So it's not a huge problem, but it is one of the reasons why the stock isn't going up as much as it is. And it pays a very small dividend, but 1.5%. So all these numbers will change, as the analysts update their numbers. So we'll come back to this another day. Okay, let's look at some more of the stocks that are going up and down. Oh, Intel. Intel had a horrible quarter, and they're laying off people, and they're not going to make their numbers. They had a very poor guidance. Um, this is a stock we've been following for a while, not one not to own, because they're basically their president for the past couple of years hasn't turned the company around. They have a new president, and they've totally lost the AI game to NVIDIA, and they're losing the market share to AMD. So they're just an old company that's not keeping up with the latest technologies. So that's a good one to stay away from. What are the ones that are going down? Okay. All right, that was a good little exercise. Let's look at the sectors going up and down the most. We have gold, miners, gold. Okay. So gold is going down a lot. Why would gold go down? Because it was it was a trade that everyone was in. Gold was the only thing until while the stock market has been going down this year, gold has been the only thing that's been working. And it's a crowded trade. And right now it's like people are getting onto a ship, and there's so many people on the ship it's starting to sink. So people are starting to jump off the ship right now. So it's a crowded trade. People are trying to get out of the trade now. And okay, let's look at the 10-year right now. It's down, it's going down. So if the 10-year is going down, we expect that to help the home builders, but that's not helping them today. They're actually down. If the 10-year is going down, that makes the interest rates for buying a house more affordable. And that should help the home building, but it didn't. That's the regional banking. Okay, let's look at the ones going up the most. We have consumer discretionary, technology. Okay, so we have a risk on market today. These are sectors that do well whenever risk is on. And whenever risk is off, you see some more conservative sectors going down. And what else can we see? We have a lot of good news in healthcare today. We had some AbbVie, a stock that we follow, had good earnings and it went up. So we're going to go check out that stock a little bit later on. Okay, that was a good little exercise. All right, so let's look at the analysis picks from the beginning of the year. A lot of them are down 8%. Cisco is down -4. That's not that bad. But cash is one of his best ideas. He thought he didn't pick any of the Mag 7 as his top stocks this year. He said there was a bit of digestion that needed to be realized in the Mag 7 world for the AI build out. And he was right about that. So kudos to him. So I guess he deployed his cash whenever everyone else is selling. So that was a really good pick, Dan. Okay, this is I went over this last week. It's good to go over it again. The 10 worst single day percent declines for US stocks between 81 and this year. You can see the 1 day decline and the return after 5 years is usually positive. The return after 1 year is usually over 20%. Return after 3 years is positive. So you can see that I was saying last week, hold on, get my quote that I said last week. When there are crashes of 10 to 20% in a short amount of time, there's usually a recovery of 10 to 20% within a few months. So we could be seeing that happening now. Okay, so just remember, um, whenever everyone's fearful, like when it's going down 20%, you got to be greedy. And that's kind of the lesson learned here. Let's go over this again. The trend going back 5 years to the COVID lows, we have a trend line that is almost perfect, and it it went down to a penny to that line during this recent um, drawdown last week. So that is super support for the stock market. Let's look at some interesting charts. Um, Philip Morris, not Philip Morris, but this is Altria. You can see it's in an uptrend here. It's a dividend paying stock. It's overbought right now, but it's one of the only stocks that's basically in an uptrend and is positive for the year. So let's look at this story about the rare Zwig breath thrust. Okay, so it was triggered today on Friday. So this signal is 100% accurate since World War II, with the S&P higher 6 and 12 months later every single time. Now, um, that doesn't mean we're not going to go down lower. So let's look at our chart here for the S&P. Um, Whenever we have this kind of momentum from a crash and it goes up afterwards, and it's like the advanced declines are so much greater, like 90%, you know, um, winners to losers, that you have a certain amount of momentum there. Now, that doesn't mean we don't retest the bottom again. It's not like the whole way up. What they're saying in this breath thrust is within a period of 6 months to a year, we could go down further. We could go down to here. But they say like 6 months to a year later, we're going to be positive. So let's look at that to see if it has any credence. Let's look at basically there are like these moving averages, and we have advanced decline ratios. And I'm not sure exactly the math about this, but they're basically saying it was triggered, and you have like a positive momentum after a super negative downtrend. So if you look at the times that this has happened in the past, this is only 20 times that it's been triggered. A week later, it's positive by 1%. 2 weeks later, it's positive by 4%. 3 weeks later, it's still positive. But look at this, 1 year later, it's up over 20% almost most of the time. So that's something to look at. It's not something that you can hang your hat on. But there's there are a couple different breath thrust signals. That's the Zwig breath thrust. There's another one from the New York Stock Exchange. It's called Super Zwig thrust signal that happened. And there's another one. There's a breakaway momentum, and there's a Whaley breath thrust that Walter Deemer follows. I trust Walter Deemer more than the other ones. And he says both of them have a possibility, but not yet. Not yet, as of today. So, so in general, that's when you're investing, that gives you a little bit of good feeling in your stomach when you have this breath thrust happening, but you can't rely on it. It's not 100%. We could definitely go down another 20% in the stock market from here. And it's not a guarantee. but it's something to keep in mind. If it's worked 100% for the past since World War II, it's pretty good. And if another thing is if enough people believe in this, if you haven't, it's in every news story on the internet. So if enough people believe it, then becomes true. So we'll see. But what I'm doing is I'm kind of relying on fundamentals and I'm keeping up with the statistics and making sure that the stocks we're following are still um, going to be profitable. Let's look at our stock screen for this week. We have what I did was I highlighted in green the best um, numbers, in yellow. So the green has the best 25% numbers. The yellow have the 25 to 50% best. And a lot of times I look at this, I eye it up, and I see what green, what has the most green. And we have a Chinese company, PDD. They do Temu, but we're not going to go over that because Chinese companies are really hard to get my head around. But I highlighted some good companies here. Google, they're down 15% this year. Eli Lilly, they had amazing news recently, and um, they're growing around 30%, non-tech stock. And Goldman Sachs, they have a PEG ratio of 0.45, that's half priced. And I'm sorry about that. Uber, this is another company that's I highlighted as an interesting stock to look at. Okay, so let's look at our watch list. This is the stocks that, we have the stochastic charts. These are all the stocks that we follow every week. And I put them in order of which has the return to date for each of these. And you can see some of the safer stocks, the stocks with drugs and that sell cigarettes or telecom companies. They're doing the best this year. And the ones doing the worst are the ones that are higher growth stocks. So whenever we have this dichotomy, I like to look at stocks that have done the worst this year and try to find some of the gems that others have thrown away. So we're going to go over a couple of these stocks. We're going to go over Meta, and we're going to go over Google and Abby, because they had the earnings out this week. Abby and Google, or Alphabet. Meta's having their earnings next week. So I'm going to go over each of those. Okay, so another thing to keep in mind when the stock market is crashing, if you look at the bear markets and you compare them against the bull markets, there you can make a lot more money in the bull markets than you do when you lose money in the bear markets. So whenever you have this little downtrend in the stock market, in general, it usually isn't as much as the amount the stock market goes up in bull markets. So, okay, here's a new story. AbbVie hikes its outlook on the back of two powerhouse drugs. This AbbVie stock had a drug called Humira that was coming off patent last year. So that made up most of their sales. And they started acquiring companies and products from other companies to make up that expiring drug. And it turns out that they've done better than expected. They have Skyrizi, and that soared 71% a year, and then Rinvoq is 57% growth. So this stock is on a tear right now. It's seems like it's growing 20% last year to this year, 14% this year to next year. So it's grown around 14% recently. Their PE ratio is only 14. So their PEG ratio just about 1, but they also pay a 3.53 dividend. So if you add it up, they're growing like 14, 14% plus 3.53% yield. So that's 17.5% total return. Um, okay, so they just had the earnings come out, and they were stellar. So that is great. And um, the other thing about the company is you can see that this is a perfect time to buy because they're oversold. They're in the trading range. Look at this, going back multiple years. And they're at the bottom part of their trading range and they're oversold. So it jumped a little bit today, like two or 3%. Um, but if you're looking to diversify your portfolio into drug company, this could be a stock that's a total return of 17%. The 3.5% yield is pretty decent. It's really hard to find a good yielding company. So if you look at their numbers, their market cap is 319 billion. Their forward PE is 14, and according to Yahoo Finance, their PEG ratio is 0.4. So Yahoo thinks that they're actually growing at 28%. I didn't see that. Profit margin is 7.5. That's half of what we're looking for. And return on equity is 62, which is 6 times what we're looking for. They have 68 billion in debt. That's kind of a lot. 63 billion after you take out their cash. So 63 billion out of 319, that's not that bad. They have to work on paying back that debt. And they do have 19 billion in free cash flow to pay that off. So they can pay that off in 4 years if they really wanted to. But they bought a lot of companies to pay for making, they had this Humira expiring. So they had to invest in companies that had new drugs like Skyrizi and Rinvoq. So it's turning out to be a pretty good story. Okay, another one in the news recently, Meta. They've been Mark Zuckerberg's been on the stand at an antitrust hearing for the past week or two. And so there's a lot of negative headlines around them possibly being broken up or some some kind of action against the company, such as they might have to sell off WhatsApp or some of their Instagram or other parts of their company to um, allow competition. But you can see they're growing around 14% from this year to next year. So in the past, they've grown between 14 and 20% year over year. So, and their PE ratio is only 20. So they're almost fairly valued. Right now, if they're growing at 14%, their PEG ratio is 1.42. So that's not that bad. Um, let's look at their numbers. So according to Yahoo Finance, their PEG ratio is 0.81. So Yahoo Finance thinks they're growing at 24%. So they think they're 20% undervalued. Their market cap is 1.35 trillion. Their profit margin is 37. That's 3 times what we're looking for. And return on equity is 37. That's 3 times what we're looking for. They have more cash than debt. So that in itself will reduce. They have 30 billion in cash. So that'll make their PE ratio something like 15 or something if you X out the cash. And their levered free cash flow is 36 billion. Right now, their biggest thing against them is they're spending a lot on the AI infrastructure for their company. So they're spending all of this cash that they're making. So eventually that spend will stop, and that's when the company will start. Um, the stock will go up whenever it stops spending so much money on AI infrastructure and other things. Okay, so let's look at the meta chart. You can see that it's down like 9% this year, and it's like a little downtrend. But all these other charts are starting to break out here. Now you can see that we're right in before earnings. Our earnings are coming out on Wednesday. So there's a very good chance if they have good earnings, they're going to like hit the top of this range and continue this uptrend. Um, but if they disappoint, they'll go down here and resume this downtrend. I think they're going to do good with the earnings because Google came out with stellar earnings this week. And usually whenever Google has good earnings, they're a very good comp to what Meta will have for earnings because they're in the same industry of advertising. Okay. All right. So let's look at the numbers for Google or Alphabet. Okay. So there was a story. Google stock rises as it beats on earnings, strong margins, raises dividend, authorizes 70 billion. I mean, the stock was up 5% on this news. It traded down to like 1% up for the day. Um, so the stock is growing around for the past 20 years. It's grown around 14% a year on average. They're seems like they're growing only at 8.5% from this year to next year, and then they're going to resume their 14% after that. So, but they're down. Let's look at the numbers again. How much they're down this year? Google is down. Alphabet is down 14% this year. Okay, so they have some negative things about the company. They have a antitrust situation, possible breaking up the company. They might have to sell Chrome. They might have to sell YouTube. I don't know what the ramifications are, what could happen, but if you break up a company, let's say AT&T, they broke up AT&T back in 1970s, and sorry, um, the combination of all the baby bells were far greater than the original company. So if they end up breaking up Google, the sum of the parts will um, be worth more. I mean, the parts of the company that are broken up might be worth more than the actual company itself. So, so that's an unknown. That's one of the negatives about the company. But if they're allowed to keep this monopoly and they don't have another negative thing about the company right now, Alphabet, they have AI encroaching on their search business. There are people using Grok on X, and they're using ChatGPT as their Google search, and it's giving them answers much better format than Google. And the younger people are starting to use that instead of Google. So um, right now, their earnings came out, and there was no indication that they were eating into their profits. But you got to keep track of that and um, be willing to make a move in your portfolio if you think that they could be losing some of their moat. So there's a lot of things that could, I mean, that's why the company is probably down 15% this year. All right, but they're doing everything I mean, they have excellent earnings. They were up 5% and then they went down to 1% at the end of the day. So it's interesting that good news is not rewarded. And sometimes good news was not rewarded for Google today, but bad news by Tesla, they had the worst earnings report I've ever seen. And their stock went up 25% in a week. So I guess you have a market that's not rational, really. It's going on emotions. So that's why we're looking at the numbers like this every day. And if we see a stock going down and they're undervalued, we're going to look at it. All right. So Google has excellent numbers, 2 trillion company, Forward PE is 18. If you back out the cash, it's like 14 PE. And their PEG ratio is 1. So Yahoo Finance also thinks they're around fair value. Profit margin 30. That's 3 times what we're looking for. Return on equity is 34. That's really good. 3 times what we're looking for. Total cash minus debt, they have 70 billion in cash, and they're going to do a 70 billion buyback. Leverage free cash flow is 64 billion. So they make 64 billion um, in free cash flow, which is amazing. More than any company. Maybe Apple might be more. Um, let's look at okay. Let's look at this chart on Google. You can see that it's in this downtrend, and we're right at the edge, at the top of this downtrend. And if we have some good earnings reports next week, there's a very good chance that this breaks out, and then we might start resuming this uptrend from before. And we're right on the top of this trend line. We could either go down here next and then make a lower high, lower low, or most likely we're going to start a new uptrend where this is the low and this is the high. Um, so let's watch that, see what happens. All right. Well, I hope you enjoyed that talk. That's all I have to say for today. If you have any questions during the week, let me know and I'll try to answer them for you. Have a good week of investing. I'll see you next time.